Hello, ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. We've got a lot to talk about today, but of course, the pivot that many expected has now been extinguished. Jerome Powell and the Jackson Hole Symposium. In 10 minutes, he managed to wipe off $3 trillion. Yeah, he's a powerful man, possibly one of the biggest in the world. And of course, more pain for households and businesses in America, and in fact, the world, is really what was on his lips. Yeah, the Fed doesn't seem to have pivoted, and it means that there's a lot of discussion points that we need to talk about in the future. Key levels and everything else to do with the markets right now we have in today's video, and we'll see you very soon. Stay tuned. Well, welcome back everybody to the show where we talk about stocks, commodities, and cryptos. Fed Chair Powell sent shockwaves through this market, as we mentioned. Higher interest rates will bring pain to households and businesses. Here's a bit of an excerpt of what he really told us. He said, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. He basically said he's willing to do so, and he has to do so because the historical record cautions strongly against prematurely loosening policy. We talked about this last week, the idea that inflation was most likely going to be sticky. We've got, of course, rents rising out of control, food, a big problem there. And while energy may fix itself to some degree, it's going to force the Fed to remain high on interest rates for a longer period. They also have never killed interest rates, or they've never killed inflation without having the actual Fed's funds rate above the inflation number. Will that happen this time around? It probably will. And most forecasts now have inflation dropping to under 3.5% in the next year to 2 years. Yes, that means that, of course, if the Fed remains sticky at a high above 3.5%, they'll actually be able to counter this. And that's a good sign for America if it's possible to do so. But let's talk about weekly changes in the interest rates here. A great chart shared in our private community by one of the members. And this is all of the forward rates right now. So you can really see where the interest rates are expected to go and where they're expected to peak. Between March of 2023 and April, it's expected from the bonds market as of the close on Friday that we will hit around 3.75% in terms of the federal funds rate. People will really be feeling the pain there, especially households, and consumer and demand will no likely drop like a rock. Now, of course, has the market allocated this into the stock price? This is something that many people will be discussing. Here's the updated version of what the economists think about interest rates moving forward. You can see the two numbers coming out in terms of they're kind of split between 50 basis points and 75 basis points still. But in today's video, we've got some really amazing stats to be sharing with you before we get into the charts and discuss the key levels, because there's so much to really talk about. The VIX, what's happening there? We've long since talked about the idea that 20 is the key level. We talked about the VIX being purchased at 20 by bigger players with the idea of going into August, September, and October, the weakest months of the year, and seeing some kind of kangaroo market, a very high volatility zone. How do you really action something like this? It's got to do with options. But look here at the VIX and the call put ratio over time. It's interesting. The call put ratio often precedes the VIX actually spiking. Here are the times that it's happened before. Now, of course, it's not always accurate. Here's a massive spike of the call put in terms of ratio, and it didn't happen. But generally speaking, we've just seen a big breakout here, and the call put ratio for VIX has now spiked to a very high number above 50. Does this mean volatility is still set to shoot up over the next coming months? It certainly could be. Here's another very interesting study of MACD, and this is MACD across a 200 SMA as well. So we know that when we hit 200 SMAs, like we discussed a few weeks ago, it sends shockwaves through bear markets. Basically, when a market is declining and it pulls back to this 200, it's often a period or an area that causes markets to fall. It was the right time in the right place with the right amount of FOMO going into these markets. But now with the MACD switch as well, what do the statistics tell us over the next couple of weeks? Well, it's not good necessarily if you're a bull over the next month, 2 months, and even 3 months. Look at some of these horror percentages. I mean, of course, the median percentage drop down is not huge, but over the next 3 months, if you took this reading, it was negative 9.4% from this reading as of course, the Friday announcement. Does that mean that we'll go back and test new lows? Well, it's certainly not boding well for bulls just at this stage over the medium term, that is the next couple of months. A good data point for a time of year that we already know is weak. Real liquidity is also already showing us that we're in a recession. We already most likely know this. Most of you guys in the comment section have a fair idea. But of course, the markets here, the M2 plus equity bond mutual fund ETFs have fallen to lows that we haven't really seen for a very, very long time. And it kind of usually shows that when liquidity drops to these levels, it's associated with recessions coming. Rejecting the 200 SMA is also important in terms of averages down. We're actually already past the average, which is 7.95%, usually what happens next. But it's a good little stat there to have, and this is shared in our community as well. If you're ever interested in joining the community, you can do so, free 7-day trial down below. Consecutive weak outflows from European equities. No one wants to take risk right now, especially in Europe. The DAX, we've discussed this a lot. Outflow, outflow, outflow. Ever since really the whole war in the Ukraine and Russia broke out, it's just been mostly risk off from those markets. We've also seen a very surprising trend of some of the biggest outflows since November of 21. Remember, this preceded the crash that happened in 2022 from big funds. Big funds have started dropping tech. Does this mean worse things are to come? Well, of course, we'll be following that and, following along as much as we can. Midterm election years, we know September into October are the worst months. We've talked about this, I would say, all year really. And if you haven't ever seen our videos before, consider subscribing because we always bring this big data to you guys. So it means that the big guys are back. Basically, the summer holidays are about over in the US. Things are about to get real. We've seen incredibly low volumes throughout August as everyone's on holiday in the Hamptons or wherever else they are in America. And basically this leads to, of course, everyone coming back. They need to make some money. What are they going to do? Potentially flush some retail traders. So where are retail traders going to be most vulnerable? Well, it's most likely going to be vulnerability somewhere around previous lows, or at least a dipping area. Remember, we talked about these correlations from previous times in the market. I think this really underpins our current strategy for the medium term. And that idea is that in all of these cases with correlation, markets came close to almost straight back to the lows previously formed. Look at the two bull cases, and the bear cases, of course, followed on. So it's not time to feel FOMO about having to necessarily buy the market. Obviously, you follow your own strategy, but this is a very interesting correlation, and it seems to be following the similar track records that we've seen in the past. Now, it's not all doom and gloom. Of course, while the Fed said what they have, the market's already allocated to a degree some types of risks. My personal feeling, if you would ask me, is that the market still believes in the Goldilocks scenario. That is that everything's going to work out, inflation's all going to be perfect, and everything's all good, and Papa Powell's got our back and we'll start printing again in the future. The problem is the Goldilocks is most likely not going to happen, and that's a mixture of government, real incentives in terms of going out, increasing demand marginally a little bit more, and other things that are sticky in this economy. So will this stat hold up? A lot of people know that when the bear markets recovered to over 50% of the entire pullback, which they did recently, it was about 42.50-ish, 42.26, that usually the bottom was in. Here's some stats around that. If you're a bull, if pullbacks happen, are you going to take that as an opportunity? Certainly you could do so if you believe in that stat, and it's held up the whole time. Here's some calendar information if you're interested in anything to do with things moving forward. Obviously you should be. There's a whole bunch of data, and the Fed is, remember, data dependent or data driven. So we need to be following that. And we'll move over here now to what we're seeing under the hood. So for anyone that's never seen this before, you've got to follow the funds and the money flow. A few weeks ago, we talked about the idea that utilities, staples, and healthcare were performing better than other market sectors. We also saw inflation sectors, energy, and also metals improve heavily. This is the rolling period of just the Friday session. But when we take it out to the month of August as a whole so far, you can see the two inflation sectors doing the best. Then we've got agriculture, utilities, and not far behind, we've got things like staples. Now, healthcare admittedly didn't hold up very well. But the others were kind of holding around their zones. And that meant that maybe the street was sitting a little bit protected during the month of August in terms of under the hood. It's always important to follow the sectors because following the big money flow is super big deal. So with everything being so crazy in the markets right now, you need a good broker, guys. And I'd like to thank the sponsor of today's video, which is Tiger Brokers. They have a whole bunch of different instruments, but more importantly, they've got great tools. So over here on the right-hand side, you'll notice there's a whole bunch of level 1, level 2 information about stocks. But a lot of people don't know that when you go over to the analysis or financials, you can click more and get further information about your favorite stock, whatever that might be. So we have Tesla here, and you'll notice we can see the short volume on any particular stock. We can see the shareholder information, of course, who holds the biggest amount. We see you, Elon, over here. Of course, he's the big holder there. How much they've increased or decreased their variations of that. The dividends provided by certain stocks in the market. What are the best dividends? What are the best potential companies to be in? The fundamentals, a great way of interpreting the information. You can look at the growth charts, the operations, the solvency, the cash levels. Everything is in really this stuff. And you know what? Most brokers just don't offer this. So to be able to go in there, look at cash flow statements, financial analysis, balance sheets, income statements, and everything else within one platform is phenomenal. And there's a whole bunch of special offers, which is the good news for you guys, in the links down below. So depending on which country you're from, you can have a look there. And if you'd like to check out Tiger Brokers, you can do so by clicking one of those links. What happened to the VIX? Well, it spiked massively. We went back to 25.5. We already know the VIX at 20 was a big deal. We've discussed it many, many times. For anyone that got calls in the VIX, you're probably celebrating that day. 17.26% up. I mean, it's a big level, yeah. It's 17.26. That's a pretty giant jump, but it's still nowhere near the 35s that we've seen before that have often been correlated with the bottoming effect of the market. So with basically the VIX jumping up to a pretty key level in terms of 25, will we continue to spike? Well, let's look at the weight of evidence so far, and we'll go through all of the charts and we'll check them all out. The first one is the 2-year. Did it really do anything? A lot of people messaged me about this one. They said, Tom, yeah, it made or basically got to the same equal highs, but we didn't spike out. I think the thing that was bigger about this is that the market basically said, oh, wow, okay, Powell is going to still beat inflation in terms of he's not going to change anything. And I think it's also more of an excuse. Most people probably expected Powell to have to beat inflation by keeping the rates at a high level for longer. We know it's sticky. And remember, the market's all due to manipulation. We'll still be watching the 2-year. And if the 2-year explodes, get set because the markets will fall further. But I think the 2-year could remain kind of sticky around here or even just drop a little bit. And we could still see markets fall over. Where you're going to go really bullish is if the 2-year falls under these levels that we hit in July and August again, 2.8%, an important alert that we might want to be setting for the future. I don't think that's going to happen, but we'll find out whether it does. What about the US dollar? Well, the US dollar went down heavily and then bounced straight back up. Big bullish looking hammer here, multiple rejections, and it would have triggered a whole bunch of extra shorts. If you remember back to our Friday video, or Thursday video as well, that we've talked about, we spoke about this area here being a bit of a sell-off zone, or at least the last level where the bears had the power. It did sell, and then it bought up massively. So if you were in the initial sell before the whole news and the Powell and all of that stuff, things actually were looking pretty good. Then it reversed. This is the type of signal that you think could push actually the US dollar even higher. Because when you think about it, that's a big reversal. It's come back to some kind of median reversion for certain time frames. And if we now make a new high past 109.26, we might see a little bit of a spike up here in the US dollar. Now, that doesn't mean that it won't come straight back down, but it does mean that you've got to be patient here if you're not already in longs with this particular US dollar, because this is a critical, very scary zone to be potentially buying in. We're almost at double top territory. Yes, we've got a strong signal here towards the bullish side, and potentially also the Monday into maybe even the Tuesday might rally through. But once we make this new high, what happens here will be important. Do we make a new high and instantly trash and go underneath it? We could be in for a sequencing that could lead into what we call a Wyckoff distribution at this point. We also could see a hold close above, and then we go into a whole new bull case scenario for the US dollar. So there's a lot to go on with here, and you've got to pick. A trader has to pick high confidence zones to make the decisions. Gold, yeah, nothing much going on there. We talked about 1772, didn't quite get there previously in the week. We've still got our targets for the market or gold to get back down. And of course, if US dollar goes strong, what do we expect? Gold will go weak into these levels here. So we're still looking at that 1710 to 1715 zone, or even a very important 1706. Anything in here will be, of course, highlighted in our weekly videos. So make sure you subscribe because we'll be following along gold very closely moving forward for sure. Let's move over to US oil. Long leg doji. Indecision on the day. Neither bullish nor bearish. Overall, the trend looks to be a little bit bullish here for energy. It kind of snapped a little high. It's pulled back a little bit. Nice little doji. If it breaks to the high, which is the price of around 94.06, that could be a pretty serious thing that could move us forward. And we'll be watching oil pretty closely, I think, this week. Could be some nice trades on that one for sure. Move over to the US 10-year. It hit that level that we thought and rejected against it. I do think the US 10-year is incredibly high right now. A lot of people have been talking to me about TLT, and I kind of agree with them. At some point, TLT becomes a pretty good, longer term, medium term strategy that is multiple months into years. You really don't want to look at TLT from a 1 week standpoint. That's just not the way that bonds work in long duration. But the higher interest rates go on the 10-year, the more chance that you're getting a better price for the TLT long term. This economy is sick. Eventually, the US 10-year will turn down. We will beat inflation, hopefully, at some point. And when that happens, TLT may be the best friend. And in fact, it could be the first turner in this market. A lot of people have never really looked at it properly, but check this out. TLT is down from its highs. If you look at it from here, down from its highs, 36%. That's a lot. Now, from the perspective of November 21, it's still down 26.79%. So in some ways, if it was just to return back to where it was in November, which just means that, of course, the US 10-year would drop because of the sickness in the economy, would that be a better risk reward than something like even the S&P 500? A lot of people and bonds people are all looking at this. It's the most attractive time for bonds for quite some time in the markets. And I've never really said that over 12, 14 years of doing this. The bonds look semi-attractive. They're starting to do so. We'll find out how that moves. Tesla did absolutely nothing. In fact, it was another one of those kind of safety stocks after the split. It's holding up pretty well. 288 down 2.7% on the day. Not bad at all. We'll get into some indices in a moment, and we've got a lot to talk about with the S&P 500, obviously. But it kind of just held up. Came off that volume profile that we had here, and it's coming back into what now would be that 280, 290 zone. So we're already in the 288. Can we get down to 280 through the Monday session? I think a lot of people will be interested in potential buys off this zone. Yeah, it might be worthwhile focusing on the small timeframes. We'll find out. Apple over here, weak. It almost cleared the gap. If you look here, look at that. Oh, so close. And this was the story of the market. You'll see how close we got to some of our key first levels for the Jackson Hole Symposium spike. And it actually went up during the day, if you can believe it, before going down. But yeah, it went just a little bit and then straight back down. New lows, obviously 3.77% down, pretty brutal. The movement now could be towards even the 157. Now, if this happens and we get that gap filled to 157, of course, be careful on Tesla. It could move a little bit lower. But this would be a very interesting point for a whole bunch of market reasons. And we'll come back to that in just a second when we look at the S&P 500. Apple, closed gap to 157. Certainly a story of this week. The DAX got walloped, got smashed. 3.84%. Big sell-off. Worse than, of course, the S&P 500, as we usually expect. Unfortunately, the DAX is always going to suffer a worse fate at the moment than the S&P 500 from a drop level perspective. Where's the next big support? Well, seems to be kind of down here, around that 12,500, 12,450. Could it just fall like a falling knife straight into that zone? It certainly could. The other opportunity is it pulls back into this area, into this boxed area that was previously a beautiful support, which we talked about, and then sells off. And most of you want this scenario. I know a lot of you want this scenario. A few people messaging me about that. IWM, it's on support, kind of, did break to a new low. I don't really like this chart at this stage because I want to look at things like the Nasdaq and also the S&P 500. So the Nasdaq has this long-standing kind of little trend line behind. That sits at 12,250 if the market was to fall off a cliff. We also have previous resistances right there and an interesting point in general. If you load up something like a fixed range volume profile and you chuck that across this thing just up until this point, you'll notice it comes in a little lower. But as we pull it back to get actually the rest of the market structure that we've seen through this point, you'll notice that it starts to come up a little higher. And as we pull it back even more, it'll come up even a little bit higher to get more in line with this area. So basically we have the most important zone, which we already knew, which was right here across the board. It's now taken it out. That was a big deal. What happened here on Friday was a massive deal. For a lot of people, this will now be a head and shoulders pattern. They'll take the left shoulder, the head, the right shoulder, and they'll say, okay, let's extrapolate that out and get a bit of an idea of where the market's moving to next. You take that distance and you'll get down here. Now that is also, with all of the available data that we've got right now, a very important volume profile level. So we've got some big key zones going on around the 12,000 area. What if we spiked into this and then rejected? Certainly a key level to be watching. 12,000 is now going to be on a lot of people's minds for the US 100. So definitely something to watch. But the S&P 500 usually leads us the way. So let's have a look at the S&P 500 because that gives us the best signal. This was a big sell-off. Of course, other people looking towards the pullback here and then sell-off. If I was guessing, I would think a pocket sell would be the best thing this week, which would be a market pulls back to, let's say it drops off a little bit more or whatever, market pulls back to the golden pocket, which would be around 13,000 at the time of this recording. So we're at 12,500, a 13,000 pullback with a sell around that zone would be the new kind of scenario. Let's move over to the S&P 500. Big deal here. Obviously, huge sell-off. Sold through all of the gaps. The 40.90, it's gone. The 40.72, it's gone. And we've left the previous three gaps behind. Now, this is where things got really sneaky because it's all about understanding, and just bear with me with this chart for a second. It's all about understanding your risks. We talk about two concepts here on the channel. The first one is always going to be risk versus reward and scaling. When you come into the Jackson Hole speech, you've obviously already seen that core PCE number. That actually spiked the market to a new high. So let's go and have a look at the underlying what actually happened through the Friday session because we need to understand this pretty closely. The market actually went bullish for a period there. Our aim, admittedly, was at least to close the gap of 42.28. We also wanted, of course, 42.40 and 42.50. At that point, we were expecting the market to do exactly what it's done so far. Unfortunately, trading is not perfect, yeah? So even if you were going bullish down here, like we discussed last week, if you're coming into one of the biggest announcements, are you going to potentially scale back your order? That's a question you've got to ask yourself. My answer is always yes. Potentially you've already got quite a lot. Why don't you take half of your order off, 2/3 of your order off according to the news? If this was one of your first targets, and then that was your second target, then you're getting pretty damn close to it before he speaks. Remember, it's very close before he speaks to this number. After that point, of course, we know the history. It just went bang, straight back down. It was quite difficult to get into. And this brings me to my second point. We've discussed the idea that back of August into September into October is incredibly weak. So how do you sell a market? Well, firstly, you've got to get the best level. We know the big levels were over here. Many people have been following the channel for a while. This was our trigger. This was our sell. This was our sell. And we were in. We knew this was a great take profit zone and we expected a spike back up. If you're selling for pockets, let's say you're selling for a market to weaken, you've got to use options. It's just the easiest way to do so. Because what you can do then is it's more about time. You might say, I believe the market is going to fall over the next 2 months. But the problem is if you trade it, what's going to happen? You might get stopped out. Stop loss hit, stop loss hit. You freak out, it's all bad. With an option, of course, a buy put in this case, you could potentially say, okay, I think the market's going down to a level we'll discuss in just a moment, the 3920, 3900. If you had an option there for the right time, all of this is just noise. Your direction is here. So when you're shorting the market, one of the best ways to do it is an option. And I've been doing some mentoring with people recently, and they've been applying two strategies. They've been applying, of course, the short-dated scalping day trading, like we talk about a lot on this channel. And they're also applying that multi-month kind of swing-based concept, which we triggered up here for, of course, potentially down into this 3920, 3900 zone. So it's really important to have two different strategies. Can you now sell puts, or at least in case of buy puts? Can you do that? A lot of people message me, is it too late to get in? Is it too late? Well, it depends what happens next. Let's practice the concept here, guys, of patience, react, don't predict necessarily from the action of what we've just seen on this market. It was massive. There's no doubt. This was a huge move. Huge. It was a big one. The Fed is not pivoting. Everyone was freaking out. It was probably a little weak in terms of the volume that really came through for the session, considering the magnitude of these moves. So what's the next likelihood? Well, let's just add a couple of things on here. We'll firstly just quickly add a fixed range volume profile for this move, just to prove how important that 41.25 was. We know that was a huge zone. Huge, huge, huge. So because we know this is a massive zone, could the market come back to hit this area again, test it this week, and then potentially switch at this point? It's certainly a good case. And I think you've got to practice patience. The other opportunity is it just keeps falling off. Sell, 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 sell. 4,000 or 39.20 could become the next levels. If that happens, maybe you do want to then say, okay, well, this market fell off quickly. Let's look for some structural base and go bullish. That's a trader's mindset. So we've got 41.25, still a very important level for this week ahead. A pullback into that zone could be very, very interesting. We'll talk about that later. We'll get rid of this volume profile now, and we'll move over to the other concept, which is how low do we go on this market? Well, again, a lot of people are saying head and shoulders. Yeah, patterns are patterns. Of course, they're worthwhile considering. And if I like to always proof a pattern. So if we take a pattern here and we proof it out, what's it kind of telling us? Well, it's showing that the potential is really there towards this 3900 zone. And the 3900 zone also just so happens to be, of the last movement up, the golden ratio pocket. So there's a lot of synergies here. There's also a gap around that area. So there's a lot of synergies here with this particular level or zone. When does it hit it? Is a question everyone's going to ask. We don't exactly know. Of course, we don't know when it hits it. There's no guarantee it will hit it, but it seems likely now that the market will come back down here. Remember, our original plan was this. Obviously, stuffing around on the way down, but that was our original plan. The only thing that changed in the plan is instead of going from this area here down, we went a little earlier because Jackson Hole Symposium and Papa Power, what he says, just says, oh, pain to come, guys, pain to come. It's nasty. So the ideas here would be pullback to potential short off, full on drop to potential structure up. And at this point, coming into this week, it's going to be very difficult here to just say, okay, I know clear direction at this point, because it's not really a high reward style position to be right at 40.42. You need to see the next market move, and it could be all the way down and you'll be like, oh, I missed out. Well, don't panic. Always have the patience to really react. Don't predict. Join us on the Monday open stream as well. We'll be talking about it all right there. So it's just a little bit of a rundown to different styles that you can use to achieve those goals of whether you want to go negative or, of course, positive on markets, and where you can do so. So this might look really confusing, but the reason I've got these two here is they're the gaps that we filled. We actually just went bang, bang straight through those. We still have these left, and we have a big kahuna one at 39.20. So just remember, 39.20 is a huge zone moving forward. Let's look at the options chain. Unfortunately, all these poor suckers are going to lose. I don't know who's got these. 445 calls coming in to the 31st of August expiration. Well, that's not going to happen. Let's move over here to the end of the week, though, the 2nd of course, September. And we've got here a decent amount of 400 puts and we've got some 380 puts. So we could still easily spike underneath 400 for the week, hit like a 390 and then bounce. We could also just go straight to 400 and find some structural setup. Look for the structure around 400, 390, and of course, 41.25. They're going to be some of the key zones that we'll be watching. Let's check out the crypto market. It weakened. A few people in the community, they were short this coming in because they looked at it and they said, look, this short-term trend line, what do you think? It shorted, it came back, it came underneath it, it rallied back to that point and just went bang straight back down. I'm not really too excited about the crypto markets at this stage. Obviously, Bitcoin sitting on 20,000. You would think that it's more likely to probably go down further to 19,000. We don't know that yet, but that's a big support there. Flag at this point. So it just kind of kept coming to this point, never really broke out properly, bang, straight back down. So there could be even further sell-off here in the crypto markets. Be careful in this market right now, guys. It's structuring up over the weekend. If you haven't already, come and follow us at FX Evolution on Twitter. Definitely come check us out there. And remember, let's have a look now at the week ahead in terms of news. So when we scroll through, we've got consumer confidence, the JOLTS job openings, Tuesday, August 30th at 10 a.m. New York time. Then we have the non-farm week, the first bit of data, the non-farm employment change, 8:15 a.m. We've got CPI for the CHF coming out 2:30, which could be a thing. ISM manufacturing PMI, 10 a.m. here, which is again Thursday. And then the big one, it's non-farm payroll time again. It seems like the news doesn't stop. And of course, now that the data-driven Fed is around, this is going to be some of the biggest data points for us to look at. So the jobs numbers come out Friday. Expect them an hour before the market opens, 8:30 a.m. New York time. And that's going to be a big bit of news. Remember, guys, if you're interested in following along with us, you can follow us on the socials, join our Discord community. And of course, if you're interested in anything of the special offers of Tiger Brokers, you can check them out in the links down below. Thanks so much. Subscribe, give it a like. We'll see you in the next video. Bye for now.